If you own a manufacturing business, I'm sure you've asked yourself from time to time, what's my business worth? But if you're simply taking an EBITDA multiple from a friend or an old business broker and assigning it to your business, that's dangerous. You're either not going to sell because it's too high, or you could be leaving hundreds of thousands or even millions of dollars on the table. Hi, I'm Jim Loeffler, CPA, CFE, MBA, and founder of InTune Business Advisors, where for more than 20 years, we've helped manufacturing business owners enjoy financial freedom through superior business valuation, growth, and exit planning services. So what is your business worth today in 2026? Well, think of what we've got going on. We've got tariffs, reshoring, technology, including AI, supply chain issues. All of these trends are all conspire to throw values all over the place. So if you're not careful and you just take an EBITDA multiple that you know from the press or a general manufacturing EBITDA multiple and assign it to your business, you could be way off. So today I'm going to walk you through the 3 core or generally accepted business valuation methods. We're also going to talk a little bit about the things that the buyers love to see in manufacturing businesses and other risk points that you should get on top of today before you put your business on the market tomorrow. So what are the 3 core valuation methods? Well, the first one is called the income approach, and that is a very popular approach. It's also known as the discounted cash flow method. And basically what you're doing is you're taking your normalized earnings and you're transforming those earnings into cash flows and projecting those cash flows into the future through forecasts. And then you're going to discount those cash flows back based on a risk-adjusted discount rate. And then you're going to subtract any debt and you're going to add any cash that you have on the balance sheet, and that's going to be the value of your business. Okay? The second method is called the asset approach. And this is where you bring an appraiser in or the buyer will, and they are going to value each individual asset or group of assets in your manufacturing business. Now, obviously, if you own a manufacturing business, you're going to have these types of assets. And you'd also want to include the building if you own it and if you are going to include that real estate in the deal. And this method is going to be higher for newer assets that you just acquired, or it's going to be lower if you have more depreciated assets. Okay, but in either case, this should represent the floor of what you're willing to accept as a price. And after you value those assets and bring them up to market value, you're going to subtract the liabilities, and that's going to be the price that you would ask. If, again, that would be the minimum that you would ask for. The third approach is one that I alluded to earlier, and that is where we're going to take an EBITDA multiple and we are going to adjust it for your business's particular circumstances. And this is called the market approach. And so what you want to do is you want to find comparable businesses, and that means businesses of your size and in your particular sector of the industry that have sold over the last 1 or 2 years. And you're going to take those EBITDA multiples and you're going to average them, and you're going to use that as a guidepost. But then what you're going to do for your particular business is you are going to adjust EBITDA. You're going to adjust that EBITDA multiple for things such as customer concentration. So if you have one or two customers that account for 10 to 20 or 30% of your sales, that's a high risk and you should lower your EBITDA multiple. If you have really clean books and you have all of your processes documented, then that should increase your EBITDA multiple. If you as a business owner are still doing a lot of the day-to-day tasks and you don't have a strong management team in place that can take up that slack so that you are taking yourself out of the business, then that will decrease your EBITDA multiple. So it's these types of factors, and some of them are qualitative, but those are the types of factors that are going to adjust your EBITDA multiple up and down. Now let's talk about what is EBITDA, because I've been throwing this term around. So for those of you who are unfamiliar with it, EBITDA stands for earnings before interest, taxes, depreciation, and amortization. Okay, this is kind of a proxy for cash flow. It's not exact, but it's what a lot of buyers use to price businesses. And EBITDA is very important because you just don't want to take your historical EBITDA and say, okay, this is the basis on which I'm going to value my company. You have to normalize that EBITDA, and that means normalizing your earnings. And this applies to not only the market approach, but also to the income approach. So what does normalization mean? Well, it really means adding back any owner perks that you enjoy, because a buyer is not going to necessarily spend that money on owner perks. It also means adding back any one-time charges or expenses over the last 3 to 5 years and other puts and takes, okay? And we've got a video, if you click below, you'll see a much more detailed video on normalizing your earnings. But essentially what you want to do is you want to take out all of those special charges or any benefits, like a one-time sale to a really big customer that you did just as an aside, but you're really not doing any more business with that customer or in that space. You'd want to bring that out, okay? But the point here is that you want to normalize your earnings and translate that into EBITDA or your discounted or your cash flows and project forward, okay? Now, what do buyers love to see? And I talked a little bit about this before, but they love to see growth. They want to see growth in your customer base, in your products, combinations thereof. That's really powerful. They want to see that the business is on an upward trajectory. They want to see, obviously, they want to see good margins. So all the financial aspects are very important, but some of the other drivers of the business are extremely important, such as your customer concentration. If you have a diversified customer base, that is really, really key, okay? I talked about growth, and if you have all of your processes documented and you've got a strong management team and that you are now looking, your role in the business is now much more strategic and forward-looking. So you're up here looking outward and looking at industry trends, and you're not down in the business, knee-deep in this detail and that detail, okay? Buyers love to see an owner who sits up here. There are a lot of different aspects to the business that buyers are really gonna wanna see, okay? Another one is your product line. How diversified is it? Okay, so if you've got one product and maybe there's a threat coming in from overseas, they may look at that and say, okay, well, this is a high risk. We're gonna have to use a higher discount rate when we discount those cash flows, or we're gonna have to adjust our EBITDA multiple downward. Okay, so think about all of these drivers and tie them back into the valuation methods I just described. So, you can very quickly realize that valuing your business is part art and part science. That's what we here at InTune Business Advisors have done for the past 2 decades, is value businesses and provide advice on where your gaps are and how you can improve. Click the link below for the top 10 questions that you can start asking yourself today to determine what your business is really worth. And if you're thinking about selling your business, raising capital, or even buying another business, click the link below for a free call with me. I'm happy to answer any questions you may have. Remember, you know your business better than we ever will. Let's make sure you get a great price so that you can enjoy the financial freedom you deserve. I'm Jim Loeffler. Get the insight, get the value, get in tune.